All right, everybody. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term Boglehead investor, author of the book Stop Being a Broke Loser, and hater of garbage YouTubers and stupid meme stocks. Now, today, we're going to look at Apple's consolidated statement of cash flows from their last annual report, which I believe came out October 2020. And I want to teach you what the heck is going on this. Because if you want to actually understand how to value a stock, you need to know how to read financial statements, okay? I know it's boring and there's no rockets. You just need rockets on this statement of cash flows, and there's no apes, and the ape father's not dancing around. I know it's boring. It's so boring. But guess what? This is truly how you evaluate a stock for the long run, okay? This is not a momentum trading channel. This is not about day trading and scalping and Bitcoin. This is about looking at financial statements and actually seeing if a company is worth investing in. Now, let's go through what the statement of cash flows is. The statement of cash flows tracks a company's cash flows. I know, that's pretty crazy, isn't it? Now, why is there a separate statement of cash flows? Here's why. We're going to go up to this amazing, delicious company's consolidated statement of operations. Now, here is where you're going to see Apple's sales, their cost of sales, operating expenses, and their bottom line profit, which is their net income. This statement is based on the accrual basis of accounting. What does that mean? That means if they sell a product and it's delivered, regardless if they receive the cash or not, they record revenue. So when you look at total net sales right here, what is that, $274 billion? Yeah, this is not cash that Apple has collected from their operations. This is simply revenue they have earned. Either they've delivered a good or they satisfied a performance obligation or a service, and they're able to record revenue. But this tells you nothing about how much cash is coming in and leaving the company and why the cash is coming in and leaving the company. Next, we have cost of sales. These are expenses. This is related to your inventory. Now, another key thing is operating expenses. There are certain expenses on the income statement that have nothing to do with cash. If you sell something at a gain or a loss, the gain or loss actually increases your net income, but you're not actually collecting cash necessarily. That gain in and of itself does not represent cash. It is an accounting gain or an accounting loss. That's why this whole statement, all the revenues, well, not all the revenues, some revenues, obviously you collect cash, but some of the revenues on here don't represent cash coming in, and some of the expenses on this income statement do not represent cash going out of the business. However, we can actually figure out how or where the cash is going and where it's coming from. And what we do is we use gains and losses, or non-cash expenses, non-cash gains and losses, and we can reconcile our statement of operations and convert it from the cash base or from the accrual basis of accounting to the cash basis of accounting. But we're going to have to use the consolidated statement of operations, and we're going to have to look at changes in current assets. Current assets are cash, inventory, stuff like that, and current liabilities. Changes in these accounts plus the income statement will help us reconcile and figure out where the cash is coming from. It's pretty difficult to learn the statement of cash flows, like if you're brand new and you've never looked at it before. With a little bit of practice, you can kind of understand at least the theoretical underpinning of why there is a statement of cash flows. Remember, income statement is the accrual basis of accounting. This is not cash. Some of their sales, of course, they collected cash, but some of their sales, they also sold them on credit to people, which means they haven't been paid. Apple has not received cash for the sale. It's very important to see where the actual cash is coming from. So let's go look at the consolidated, a little burpee there. Consolidated statement of cash flows. Now, what this does is this tells you what happened to my cash. Why did my cash change from year to year? So looking at here, we have the beginning balance of Apple's cash on their balance sheet. So let's go look and see if that actually matches. If not, maybe a little bit concerned. Okay, that's freaking weird. See, when you're doing a statement of cash flows, you're supposed to have cash equivalents, and restricted cash, 50,000. I wonder if they're incorporating in, that's freaking weird. Okay, because normally when you're looking at the statement of cash flows, you want to see that the beginning cash here represents what's on the statement of cash flows. So it's off by about 2,000. I'm really curious as to why. Maybe either the cash equivalents or restricted cash is not just in this cash balance here. It might be represented somewhere else, maybe in like other current assets. But trust me, this is Apple's beginning cash on their balance sheet. And we're going to figure out where the cash went. And at the end of the balance sheet, we're going to find the cash equivalents, and restricted cash for the end of the year, which is the current date of the balance sheet. This right here. So they have 38,000 on their balance sheet for cash. And we go down and look, and they have 39,000. Okay, so somewhere they're taking something from another item on this balance sheet, and they have to be including it in cash equivalents, because the numbers should match. Now, let's go look and slice and dice the statement of cash flows. So there's there can be 4 sections of the statement of cash flows, but there's 3 main sections you have to worry about. You need to worry about cash flows from operating activities. That's what the business actually does. They make phones and they sell them. So you're going to see the changes in balance sheet items and reconciliation of expenses and gains based on stuff the business actually does. This is the operating activity. So you're not going to see sales of buildings, issuance of stock. You're not going to see that in operations. It's going to be accounts receivable, inventories, accounts payable, things that involve what the business does. So you want to see positive cash flows from operations, because if they're not even generating positive cash flows from operations, there's a problem. Well, how do you know if there's a positive cash flow from operations? Well, you can look at the bottom of the operating activities, and you'll see that you have a number here. We have $80 billion. Now, I know that's a positive inflow because there's not brackets. If there are brackets in any of these accounts, that represents a cash outflow. If there are no brackets, that represents a cash inflow. So what happened is they took all these numbers, they added them up, they added all the positive numbers, subtracted all the negative numbers, and they got a net cash inflow for operations, what the business actually does, of $80 billion. Now, the next part is investing activities. So you may think investing is like, oh, Apple bought and sold some stocks, which goes under investing activities, but it also includes purchases and sales of property, plant, and equipment, buildings, forklifts, whatever they're using. So you're going to see what Apple is buying basically to either invest their cash, or selling investments, or what they're buying to increase their production capacity, for example. That's investing activities. So, for example, we have purchases of marketable securities. This is probably them investing cash, just to make a little bit of extra yield. Proceeds, that means they received money from maturities of marketable securities. So maybe they bought like treasuries and they matured. Proceeds from selling of marketable securities. Payments for acquisition of property, plant, and equipment. Payments made in connection with business acquisitions. Purchases of non-marketable securities. Proceeds. So you're just seeing cash coming in and out from Apple, either investing in another company's stock or another company's or government entities' bonds, and purchasing stuff to expand their business. And you'll see at the bottom, there's actually cash generated or used by investing activities. So in the last year, Apple actually had a net outflow, because this is in brackets, of $4.2 billion of investing activities. Is this bad? No, not necessarily. Because companies, of course, are going to invest any spare cash to try to make a little bit of extra money, which represents money leaving the business. And they're going to be spending money on buying property, plant, and equipment. We need more warehouses. We need more forklifts. We need to acquire other businesses to grow. A negative outflow of cash in the investing activities is not necessarily a bad thing. Now, the last main section is financing activities. This is another very important section. You can't gloss this over. What does financing activities tell you? The main accounts in the financing activities, you're basically dealing with Apple's own stocks and Apple's own bonds. So if Apple issues more stocks, you're going to see something like proceeds from issuance of common stock. And you see there's a positive number, which means they issued stock and they got cash for it. And then you're going to see outflows for things like payments of dividends, repurchases of common stock, issuance of debt. Now you may be like, oh, well, isn't that investing? No, it's not. The main difference is an investing activity, let's say they buy a stock or they sell a stock, they're dealing with another company's stocks or bonds. Under financing activities, they're dealing with Apple's own stock, either issuing it or buying it back, or issuing their own debt or paying off their own debt. That is the key difference between, seeing stock activities, buying and selling stocks under investing and under financing activities. And the last thing on the bottom here, of course, they reconcile the beginning cash. This is what we started with. This is the cash we got from operating activities. This is the cash we spent from investing activities. This is the cash we used in financing activities. And they tell you the cash at the end of the year. That's how you figure out how you went on your balance sheet from 48 million or 48 billion to 38 billion. That's the whole purpose of it. Now, for the operating activities, there's two ways you can figure out cash provided by operating activities. There's two methods, and this is kind of like an academic discussion. You can either use the direct method, which is just basically reconciling accounts and comparing items on the income statement and the balance sheet to figure out where the cash came from. Or you can start from net income, which is the bottom of the income statement, and you can work your way back. For example, in this, they're using the indirect method, which is starting from net income. You add back non-cash expenses, and you subtract out non-cash gains, losses, stuff like that. For example, we start with net income, $57 billion. Now let's check and see if that's actually on the income statement. Look at that, $57 billion. Imagine that. So these all tie together, ladies and gentlemen. 57,411 net income. And we're going to work our way back. And we're going to figure out where the cash actually came from when it came to our operations. So the first thing they do is they add back depreciation and amortization. Depreciation is basically recognizing cost of a long-term asset over its life. Because when you buy a long-term asset, you're not just going to expense it all in the current year. If you're going to use an asset for 5 years, you want to match the use of that asset over the revenues that are generated from that asset, which is why you spread out depreciation over whatever the asset's life is. Now here they're adding back the depreciation because it is a non-cash expense. Think about it. If you buy an asset in year 1, let's say you pay cash for it. Well, in years 2, 3, 4, and 5, you're just recording an expense to recognize basically the usage and using up of that asset. But you're not spending cash. The cash only happened in the first year. That's why you add back depreciation and amortization. It is a non-cash expense. Share-based compensation expense. This is another non-cash expense. Share-based or a deferred income tax benefit. That actually represents an outflow and other, whatever that is. Now, the next thing they do, so they start with reconciling net income to cash generated by operating activities by adding back non-cash expenses and subtracting out non-cash gains or losses. So this must have been some kind of gain or loss, this $215 million right here. The next thing they do is they look at changes in balance sheet accounts. For example, an account receivable is money that's owed to you. Now, if you go on your balance sheet, let's see how it changed. So we have accounts receivable. At the beginning of the year, they had 22 billion, almost 23 billion of accounts receivable. And then it actually went down to 16 billion. Now think about it. If you were owed $22 billion at the beginning of the year, And then at the end of the year, now you only have $16 billion that is owed to you. Could you possibly have collected some of these accounts receivable? I would say yes. If it goes down from year to year, you've collected cash. You've collected some of your accounts receivable. So let's see what they do on the balance sheet. On the statement of cash flows. They add it back. Why? Because you are collecting the cash. Obviously, you must have. And let's see if this actually adds up. So they have almost $7 billion of cash inflow from accounts receivable. This better frickin' add up. Sometimes they have sometimes there's a lot more detail that goes into these. These are just like overall accounts. But they should generally match. So looking at the change in accounts receivable, 6842. Let's see what it is on the statement of cash flows. 6917. All right, so there's something else. Maybe it's something to do with the allowance for doubtful accounts. But it's roughly the same, and it should be roughly the same. Next, inventories. So they're saying there was an outflow of cash for inventory. Why do you think that was? Let's go look at the balance sheet. Inventories. So they started with inventories of $4 billion in 2019. And of course, it actually goes down, which should be an inflow of cash. But there's something else going. There's basically more details going on here that they're not disclosing. But if you think about it, if you had $4.1 billion of inventory at the beginning of the year, and then you sold some inventory, it must have gone down. If you sold inventory, that means you probably received cash. Now, like I said, they're not disclosing everything on these statements, so you really want to go look in to see why are they showing a cash outflow instead of a cash inflow. Next, vendor non-trade receivables. They had a cash inflow of $1.5 billion. Let's go look at that on the balance sheet. Vendor non-trade receivables. So they started the year with $22.8 billion. And they ended the year with $21,325. So basically, because they had a receivable that went down, that means they collected cash. And they collected roughly $1.553 billion. Let's see what the statement of cash flows. Oh, that actually adds up. Wow, interesting. Apple, what's going on? What's going on here? I don't understand this. I need more explanation. This is why you have to read the financial statements and go down and dig in the notes to see why some of these numbers don't exactly match up. Does that make sense, ladies and gentlemen? Accounts payable. Accounts payable is debts that you owe. So it actually went up, they had an outflow of $4 billion. So what I think is going to happen is that their accounts payable will go down year over year. Let's see. Yes, they began the year, they owed $46 billion in short-term debts. And then at the end of the year, they only owed $42.96. So basically, they paid off $3.9 billion of short-term debts. So we go to the statement of cash flows, and we see an outflow of course, it's slightly off. So something's going on here, but you kind of get the gist. Deferred revenue. That's when Apple gets paid in advance, so they're receiving cash where they actually haven't earned the revenue yet. So they add that back. And then finally, they reconcile other current assets and other current liabilities. Now, depending on what method you're using, will determine whether you're going to be starting at net income. This is the indirect method, or you don't start from net income and you just reconcile accounts using other methods. So this is using the indirect method because they're starting from net income, the bottom of the income statement, and they're reconciling back based on non-cash expenses, non-cash gains, and changes in balance sheet accounts. Now, the rest, investing activities, you can actually look in the balance sheet as well and kind of figure out, did they buy more marketable securities or did they sell them? So we can go to the balance sheet. So they had an outflow of $114 billion, and they had an inflow of marketable securities, which are proceeds of $69 billion. So you can go on the balance sheet and you can look, let's see, marketable securities. So it went down, so they should have collected a net $5 billion. Yeah. So if you add these up, so they had an outflow, they bought $114 billion, then they collected 69,918, and then they collected 50,473. So they had a net change of a net cash inflow of $5 billion. And we can look and we can see it should have gone down by roughly $5 billion. Yes, it did. Does that make sense, ladies and gentlemen? That's the statement of cash flows, okay? And you can use that and you can look at, how the business is doing on an operating level, what they're spending their money on, or the investing activities, and financing activities. These are all important and you have to understand what's going on. What I like about this, on financing activities, repurchases of common stock. That means they're buying back their stock, which helps the shareholders. And let's see. And they issued a little bit of stock, but that nets out because they only issued, this could have been from like compensation, stock compensation. But they bought back way more stocks than they actually issued. So that's the statement of cash flows, ladies and gentlemen. If you have any questions, leave a comment, and I'll kind of explain anything that didn't make sense. But it's all tied together. All these sheets. The income statement, which is on the accrual basis of accounting. The balance sheet, how current assets, current liabilities change. All this stuff ties together. You can actually figure out and confirm whether they're actually telling the truth or not. I saw little discrepancies in some of these accounts, but nothing major or crazy. But I would be curious why some of the accounts didn't necessarily add up exactly. But that's it, ladies and gentlemen. I actually have to go back to work. I'm starting at 9 o'clock. I'm finally done with leave. But that's it. If you like this, like the video, subscribe to my channel, tell your friends about me.